afternoon, everybody. This is Chrissy from Solstice ATR and Vulcan Capital Research. I hope everybody's doing great on a Sunday afternoon. Had to redo the video. Somehow, the one I did on Saturday morning had a glitch in it and unfortunately lost it. So I'm doing a short video for the coming week on Monday. So let's first start by taking a look at the combination of those instruments. Before I do that, what I'd like to say, I want you to keep an eye on what's basically most people are looking for is a pullback in the market. And at the same time, we had a nice recovery week potential, keeping the market elevated and higher on the instruments of the S&P, the NASDAQ, the Russell, and the Dow Jones Industrial Average. And the most important thing is the small cap, the RUT, which is the IWM, which is the ETF, or the slash RTY on different platforms, or slash TF, allows us to see that the small cap has cleared the 50% fib as well as the 61.8 and keeping us elevated. The trees is basically, what we see is an opinion and what we hear. Facts are what we know, and that's what we experience in the market. If you noticed, everybody was bearish on the COVID-19 and the situation on the lockdown, and what was really, really bad is no longer bad, and that's in the public's opinion. And at the same time, the Federal Reserve Board was pumping money since March 23rd into the market to make it, sustain, the negativity in that market to keep it elevated to where it is. Is it possible that we can get a 4%, 4.23 to 6.8% retracement from, last week in the next 5 months coming? Of course we can, in order to continue higher, but it does not have to do that. And most people are always expecting something when things don't happen. Trade what you see, not what you think. And what I'd like to show you, this is basically the weekly chart, and it shows a nice week over the push higher. So I'm going to go to the daily chart, go from weekly to daily. And what I'm going to do here is basically look at the gaps most of the pivot points are. We've got gap 1, gap 2, gap 3. There's a small gap here, gap 4, 5, and 6. So this one, by accident, I did not put one right in here, which I need to. So let's do that first of all by putting an oval. I'm putting this gap right here between this candle and this one here. There's a gap. So you got 1, 2, 3, 4, 5, 6 gap on the combination of those instruments. And at the same time, we have not filled the upper gap from here, from the prior H pattern that we fell through. We filled this one here, we filled this one here. On the way up, we got those, 6 gaps going higher. And at the same time, we have virgin control points, about 12 to 13 of them that never been retested since this area here. When we gapped up and we continued higher, we've been grinding further and further away from, the 50% midpoint. Let's go look at the NASDAQ, NQ, NDX. I'll start with the strongest one. The NASDAQ 100 has actually, this is the gap, this is the 2. This one, there's a minor one here, that's 3. That one is filled. And here we grinded higher. So there's different, and depends on the, the instrument we're trading. It has cleared 100% of the prior annual drop. Historically, from February, 19, we had the 20, we came in and we fell down. We created an H band and fell lower. And since, April 6, we've been going further away from this, that little cup and handle that we created. We continued higher on a very up strength. Is there a possibility of a pullback to the 18 simple moving average or the 50? Yes. We can come back, but it doesn't mean that we have to come back automatically. Just make sure you trade the technicals. Don't trade what you listen to on the box. So let's go now look at the Dow, $ DJI. And the $ DJI, if you noticed, we have, caught up to that H pattern. We have not cleared, 100% of the retracement. We still got a little bit more to go, and we still have this gap up here that we have never filled, and we got gaps on the way down. There's one here, there's two here, there's three here, there's four here, and that's five here. So that way you guys are aware of it. Let's take a look at the RUT. I'll do the small cap. Small cap, the RUT, eventually, if you look at the highs and lows, if we take this high here to this low, we eventually have cleared this part of the H pattern. This is the high of it. We missed it by a little bit. That high was 1539.75 when we got to 1525. Is it a possibility of, side action to continue higher? Of course, we are in an uptrend. We've got a couple of gaps that we can look at. There's one here, there's two here, there's a small one here, I believe, and one down here. So there's about 5 of them right there. Let's take a look at the SPX. If you notice, the SPX has come up to the 78.2 fib, because if I take the highs and the lows of this instrument, we retraced 100% of the fib, and what I'm going to do is just show it to you on a Fibonacci. I'm not going to mark it, but I want you to be aware. We're going to go to the fib. You can grab the high and low. It doesn't matter which way you do it. It depends if you're coming back down. You want to look for the 38.2. Going up, we look usually for the 30, we look for the 61.8. Now we have actually cleared the 78.2. We have a gap up here. So I just wanted you to be aware we're above the 78.6. We usually don't use it as much, but I usually have it, and you have the 23. I do have extensions to the upside. I do have extensions to the downside. Usually when we day trading, I'm looking for the extended measured moves into the uptrend and downtrend. You can see there's a 23, a 38, and a 15. I do have 61. Here I just marked the 23. I didn't mark a fraction 127. I didn't mark the 38, but I didn't mark the 50. I marked the 161. Usually when I'm looking for extensions to the upside, I'm looking for the 23, then the 50, then the 61, on the way up, similar to the way down. That way you get actually a trade in the direction of the momentum, whether the charts are setting up on an hourly chart, a daily chart, a 4-hour chart, a 15-minute, or a 5-minute. As long as, we're trading above the simple moving average, the 20, which most people use, or a 50 simple moving average, and a 200 SMA, which we have cleared here. If I right click on it, it'll tell you, hey, this is a simple moving average, 200 days. If I right click on the yellow one, it'll show you that's a 50-day simple moving average that we use in order to tell us if the institution or the markets are usually above the 200 and the 50 in the direction of the move to the upside. If we're below, we are considered to be bearish. I'm always looking at a faster time frame, and a faster time frame than a 50 simple moving, because these are lagging indicators. It keeps me in line since the April 3rd. We've been grinding higher on gaps. We've got gap 1, gap 2, gap 3, gap 4. There's 2 up here. I'm going to zoom in to show them to you. On the SPX, I did not mark them. And we're going to get rid of that fib so it doesn't clutter the charts, because most people are telling me, please make it simpler for us. I'm going to remove this Fibonacci. We're going to get an oval so that way you can see the way the gaps are. And there's one right here between this one and that one. And there's another gap between here and this candle here. So we've got 1, 2, 3, 4, 5, and I believe this is a 6 gaps on the way up as well as on the way down. So as well, we have virgin control points. That means the volume profile, when we get it developed, unfortunately we have lost it. Let's take a look at gold, GC. On the daily chart, it seems to have retraced, because the fear gauge, since that 1754, we haven't been able to take it out, and we had lost the 1704 area. That's going to be a very critical area to recover in order to continue higher. We're coming out of the compression on a neutral, so still on a compression on a neutral base. We've been going side range. We were trying to look for, for the 1780 breakout. Unfortunately, we didn't make it. We went 2/3 of the way back up and eventually fell down due to the momentum in the market in the last 5 days being stronger than what people expected. We have lost on the daily chart, the 50 simple moving average. I will look for this consolidation in this area, the middle of this range, in order to see if I can pick up gold back to the upside in the future. So far, we are at a gold. Let's take a look at CL. This is something, since we fell in the $7-8 range, we had a zero tick. We grabbed it here, then we chased it here a couple of times on this breakout. Then we broke this one. We consolidated and broke out, and I said it's eventually gonna consolidate and fill this gap. We hit the 116 simple moving average. We haven't finished 100% of this full gap. We still have a little bit more room to it. This was 39.60, I believe, 68. And the low of this candle is 41.05. It doesn't have to. It can consolidate, come back a little bit into the 18 or this channel in order to continue higher. I recuperated, some on Tuesday, then I did some on Thursday, Friday, and I sold into strength on Friday. Got out around the 39.43 cents, and I said, you know what? I got to the 116 simple moving average. It's good enough for me. I'm going to walk away from it. And that's what I did in oil. So we reached partial retracement in oil. What would I like to see in oil? I'd like to see a consolidation in this range in order to continue higher and don't lose the 18 and this channel here from way back. If it does, then we look for the, the 30, 32, 35, because price of oil is actually, in order to break even, it's about $35. If the barrel is below that 35, they cannot, keep pumping oil out of the ground almost at zero cost. So that's where we are, and make sure that, what was really bad in the market is less bad than news. We had, the little bit, the rioting, like it happened in 1991, the Rodney King. Now we have this scenario, about the police officer, and unfortunately, it's a tragedy that we lost someone else at the same time, and people think, hey, it's good to do this. I don't want to be an activist or anything. All I'm trying to say is that we are all similar. We have different colors, different race, different religion. We don't want to make it into politics because it doesn't have any effect on what the market does. So make sure, if you look at historically on those events, it didn't have much effect on the market, only like COVID-19, interest rates, the real estate bubble, the technology bubble in 2000, 2001, the Twin Tower, the 1987, the 91, the real estate as well. They had a minor one then. We can go back to 1975 and 1950s, but I don't want to go back that far in history to make everybody, freak out. So I'm going to do one more thing. Look at the VIX and look at couple consumer staples and products that are usually, because there will be a rotation from strength to weakness. From large cap, they may be, we're starting to rotate into value play, semiconductor play, because people are coming back online and going back to work. Do we see that the United States, those 30 million people that lost their jobs, are coming back tomorrow? No, it's going to take it a while to come back. We may, end up between 12 to 15 million coming back to jobs because most people are working out of their home. So let's take a look at the VXO instead of the VX. And what I'm going to do, go for the chart. We're going to do this time frame. Instead of daily, we're going to go maximum. Instead of daily, we're going to go monthly chart. Push OK. And I'm going to minimize it all the way down. If you noticed in 1987, that was the VIX going so high. Then in 1991, I'm going to zoom in just to this area. Was at the 2008 bubble just till 1997, 98, 2003. You see the spikes. We had $50 in 1990, 1991. And eventually the VIX fell back down. Basically the fear gauge died out. Then in 1997 started climbing. 98 we had a spike. We had the 99 2000 bubble. in the tech sector. Then we had the 9/11 Twin Tower. Then we had the 2003. Then if I move to the right, we can see the same similar situation in from 2008, 2009. Then the fear gauge fell back down. We had the 2013, 2012 area where the Europeans, no, that was actually, oh, that wasn't the European zone. That was something to do with, I think, the Brexit exit. This is the UK in 2016, as well as the British, the European zone, and currency wars. Then we had the election in 2017. We didn't have much. Then we had the fear gauge from the Federal Reserve Board increasing interest rates. Then we had the tariff. And unfortunately, due to this incident, the COVID-19, were pushed very high and came back down. As long as we are below 31, 32 area, you notice my gauge now on the VXO is showing me 27.45. As long as I'm below that 27.50, 32 area of this candle, that weekly candle, the high of it is 31.04. I'm not going to worry about, market change and trend. If we're going to change, we may, end up spiking a little bit, because in the next 4 to 5 months, we can have an easy correction of 4.23% all the way to 6.8% in order to continue higher. Is there possibility of a bigger gain? Yes. You can see that as well in the SPX. Let's just put the SPX up on a monthly chart so you guys can see it. It's a similar situation. You had the drop and the spike, and I can go back in history to show it. Are we almost recovered 100% of the move? Yes, we're above the 78% fib. If you take it, inversely, you draw it the other way around. Now the retracement, do we hold on in order to continue higher? So this is what I have to tell you about it. And one more thing I'd like to show you on the semiconductor and the banking sector. I'll show the TLT, which is the ETF for the bond market. We notice we had that big spike up. If interest rates are going to start crawling back, the price of the bond will eventually fall down to this area in order to continue. This is a 20-year Treasury note ETF, iShare. What we can do as well, look at the semiconductor. I'll use an ETF, SMICY. That's a similar situation. It's showing you that the semiconductor is coming back online, and people are, when usually semiconductors come back on, part of it is copper. Most people don't look at precious metals such as, copper or palladium, things that we use in cell phones, wiring a house, building doing construction. These are the things you look into to see if things are changing in those directions. We can look at Home Depot, for example. Same similar situation in Home Depot. You can see the spike annual high as well. So I want you to trade what you see, not what you think. And I'm going to show you a value ETF as well, VALUG. It's in the, when you play in the value, if things are coming back online and things are starting to move back into the market globally, because we went from a shutdown to restarting, turning that switch back on, it turns on and off, eventually it'll pop. We reached that H pattern that we fell from. Are we able to stay above that 460 area, 465? Of course we can. We can fall back as far as, the 424 in order to continue higher. But what I want you to understand, trade what you see, not what you think. I'm going to go back to the ES, show you the volume profile only on 5 days to give you an idea where the resets can go on either side. Let's go to ES. That's the daily. We're going to go from style. We're going to change to the candle. You can see it standard. We're going to go to monkey bars. Those monkey bars, let's just, I have them on. I didn't even know I did. Okay, we have the 3-month daily. So we're going to go from daily to 15-minute, 5 days. Okay, this showing Friday. Whoops. This is Friday. This is Thursday, Wednesday, Tuesday. Monday is not showing, so I'm going to go a little further out to basically time frame 10 days so we can see a little bit more the reset. So plus sign, minus sign. Okay, we're going to count only 5 days back till the Thursday, till the Friday, Monday reopening on Sunday, all the way to the high, using a Fibonacci and taking a look at the consolidation before the breakup or the breakdown on these gaps. So we're going to grab the Fib. I'll take the low here, which is the Monday, I believe. This was 3108. 3008, I'm sorry. Close enough to the high 3,210.5, I believe it was. We'll adjust it by right-clicking on it. Edit properties. We go to 0, 0. We go to 5 here. And we push OK. It adjusts the Fib. If you notice, the Fib is right in those 2 days of consolidation before the breakout. Look for the gap in here. Look for the gap on Monday, Tuesday area. Make sure trade what you see, not what you think. Because of the consolidation, can we come back down to this area? Of course. Can we come back to here? Yes. So my 61, in case I'm going to come back, this is the area that we have to hold in order to continue higher, and we don't lose the 57 here. 57, 58 area in order to continue higher. And if we're going to go to either side, I'm going to show you the extensions on the Fibs. These are to the upside. You got the 38, the 50, the 61, and the 23. At the same time, you got the 123. I don't have the 38 here or the 50. You have the old Fib from the 61.8. And I have the 50 here, as well as the 61.8. So trade what you see, not what you think. I hope this video was helpful. I look forward to seeing you on Monday on Discord or on Twitter. You can check us out. Be safe. Take care. Over and out.